Part 1. Money flow and the hidden system. You make good money, maybe $3,000 a month, maybe $5,000, maybe more, and still, it feels like you're always one step behind. The paycheck hits your account. For a moment, everything looks fine. Then rent takes $1,200, groceries take $400, utilities, a few subscriptions, a dinner out, and suddenly, you're back to almost zero. Meanwhile, you see families online quietly wealthy. They don't show off much, but somehow, they own homes worth $800,000. They pass money to their kids, and they barely pay taxes doing it. Same country, same tax system, completely different outcomes. So what's going on? Are they cheating? Are they just lucky? Or are they playing a completely different game? I want to walk you through something most people never get taught. Not because it's illegal, but because it's invisible. Wealthy families don't avoid taxes the way you think. They don't hide money under the table. They move money differently. Short sentence. Very differently. Let me introduce you to Michael. He's 52, owns a small logistics company in Texas, makes about $35 a year. On paper, he's doing extremely well. But here's the part most people miss. After federal and state taxes, he's losing around 35% of that income. That's over $120,000 a year. That's a house every 5 years. So he starts asking a simple question. How do wealthy families keep more of what they earn? And the answer he gets isn't about earning more. It's about moving money differently. Pause. That's the shift. Most people think of money in a straight line. You earn it. You pay tax. You spend what's left. Simple, predictable, expensive. Wealthy families don't use a straight line. They use a system. And once you see it, you can't unsee it. Take Daniel. He's 29, works in tech, makes $90,000 a year. He saves aggressively, $1,000 a month. That's $12,000 a year. Sounds great until you look closer. With inflation at 3.5%, that $12,000 doesn't grow as much as he thinks. His savings account earns about that's $300 in interest, but inflation eats $420 of value. He's actually losing $20 in real purchasing power, quietly, every year. He feels responsible, but something feels off. And he's right, because Daniel is playing the earn tax save game. Michael is learning something else entirely. Wealthy families think in 4 layers: income, assets, ownership, transfer. Most people only focus on the first one. Income is the most taxed layer. It's the most visible and the most fragile. Lose your job, it disappears. Assets are different. A rental property, a portfolio of index funds, a business. They grow, they produce income, and they can be structured differently. Ownership is where things get interesting. Who technically owns the asset? You? A company? A trust? This is where the rules change. And then comes transfer, how money moves from one generation to the next. This is where wealthy families play a completely different game. Michael learns that if he earns $100,000 as salary, he might only keep $65,000 after taxes. But if that same $100,000 grows inside assets and is transferred strategically, the outcome changes dramatically. Not zero tax, but less, sometimes much less. And here's the uncomfortable truth. Most people never even realize this system exists. They only encounter it when something goes wrong. A parent passes away, a business is sold, a large tax bill appears. Too late, because the system rewards planning done decades earlier, not last-minute decision. And that's why this topic matters. Not when you're rich, now, because every year you don't understand this, you're locking in a path where money leaks out through taxes, slowly, predictably. Back to Michael. His advisor shows him something simple. Path A. He keeps earning $350,000 a year, pays 35% in taxes, invests what's left. After 20 years, he builds around $3.5 million. Solid, respectable. Path B. He restructures how money flows, uses legal structures, focuses on assets, not just income. After 20 years, he ends up closer to $52 million. Same effort, same business, different system. That's a $1.7 million difference without working harder, just smarter. And no, this isn't about loopholes. It's about timing, structure, and understanding how money moves. Tax systems are not designed to punish wealth. They're designed to encourage certain behaviors, investing, building assets, creating businesses. If you follow those paths, the rules become more flexible. If you don't, you stay in the highest tax lane forever. Daniel starts to realize something too. Saving isn't enough, not in the way he's doing it, because he's playing defense. While the system rewards offense, defense protects money, offense grows it. Wealthy families focus on both. Most people only focus on one. Michael decides to learn more, not everything at once, just the next layer. And that's where things start to change. Because once you understand how money moves, you stop asking, how much do I earn? And start asking, how much do I keep? Short sentence, everything changes. But here's where it gets even more interesting. Because the biggest advantage wealthy families have isn't income. It's not even assets. It's how they legally move money before it ever becomes taxable. And most people never see that part, not until we break it down next. Part 2. Tax timing and ownership shift. You earn $5,000 this month, but you never actually see $5,000. Taxes come first, always first. Federal tax takes maybe 22%. That's $1,100 gone. Add Social Security and Medicare, another 7.65%. That's $300 more. State tax, let's say 5%, another $250. Before you even touch your money, you're down to about $3,268. That's your real starting line, not $5,000. $3,206. Short sentence, big difference. This is where most people live. Earn, get taxed, spend what's left. It feels normal because everyone around you does it. But wealthy families, they flip the order. They don't start with income. They start with structure, and that one shift changes everything. Back to Michael. His advisor asks him a simple question. Do you want to be paid or do you want to own? Michael pauses because it sounds like the same thing, but it's not. When you're paid, bro, you get taxed immediately. When you own, you control when and how money is taxed. That's power, real power. Let's say Michael's company makes $500,000 in profit. If he pays himself all of it as salary, he could lose around 35%. That's $175,000 gone. But if he leaves part of it inside the business, he delays taxes, not avoids, delays. And that timing matters more than you think, because money that isn't taxed yet can still grow, and growth changes the game. Take $100,000. Scenario A. You get taxed immediately at 30%. You're left with $70,000 to invest. After 10 years at 7% return, that becomes about $137,000. Scenario B. You invest the full $100,000, let it grow for 10 years at 7%. Now it becomes about $197,000. Then you pay 30% tax. You're left with $38,000. Same tax rate, same investment return, different timing. You end up with more money just because of when tax happened. Michael sees it immediately. It's not about escaping taxes. It's about controlling the moment taxes apply. And that's something most people never think about. Because most financial advice focuses on cutting expenses. Skip the coffee, cancel subscription, save $200 here, $50 there. It helps. Sure, but it's small. Optimizing how $100,000 is taxed can change tens of thousands of dollars, not hundreds. This is a different level of thinking. Now we go one layer deeper, because wealthy families don't just delay taxes, they shift where money lives. Let's say Michael buys a rental property for $400,000. It generates $24,000 a year in rent. If he owns it personally, that income gets taxed directly. Simple, straightforward, expensive. But what if that property is owned by a legal structure, a trust, or a company? Now the income flows differently. Instead of going straight to Michael, it moves through the structure first. That structure can reinvest income, distribute it differently, or even pass it to others in the family, legally. At first this sounds complicated. It is. A little, but the principle is simple. You don't own everything directly. You design how ownership works, and that design changes your tax outcome. Now let's talk about something even more powerful. How money moves between generations, because this is where the real gap shows up. Most people think inheritance is simple. You pass away, your kids receive your assets. End of story. But the tax system doesn't see it that way. Large transfers can trigger taxes, and those taxes can be massive. Let's say a family has $5 million in assets. Without planning, a significant portion could be taxed before it reaches the next generation. Hundreds of thousands, sometimes more. Wealthy families don't wait until the end. They move money early, gradually, strategically. For example, there are legal limits on how much you can give each year without triggering taxes. Let's say $17,000 per person per year. If Michael has 2 kids, he can give $34,000 a year. If he's married, that doubles to $68,000 every year. Tax efficient. Over 10 years, that's $680,000 moved to the next generation without triggering gift taxes. Quietly, consistently. That's not a trick. That's the system, working as designed. Now here's where things shift. This is the first real turning point, because up to now, you might still be thinking, okay, this is for rich people. Does this even apply to me? Fair question. But here's the truth. The system doesn't start working at $10 million. It starts working the moment you have something to structure. Even $50,000. Even $100,000. Back to Daniel. He's saving $12,000 a year. After 5 years, he has about $60,000 plus some interest. Before, he saw that as a safety net. Now, he starts seeing it as something else. A seed. Something that can be structured. Something that can grow differently. Instead of letting it sit in a low-interest account, he considers putting it into assets. Broad market funds. Simple. Historically around 7% average returns. At 7%, that $60,000 could become about $18,000 in 10 years without adding more. That's money growing money. And now, here comes the shift, the real shift. Wealthy families don't focus on how to pay less tax. They focus on how to create money that isn't immediately taxed in the first place. Let that sink in. Short sentence. They don't fight the system. They position themselves inside it. Salary is taxed first. Asset growth, often taxed later. Sometimes much later. Michael realizes something deeper. If most of his money comes from income, he's always playing defense. But if more of his money comes from assets, he starts playing offense. And defense is how wealth compounds. Daniel sees it too. He's not bad with money. He's just been playing the wrong layer of the game. And once you see the layers, you can't go back. But here's the thing. Understanding this is one step. Applying it is where everything changes, because knowing the system exists doesn't automatically put you inside it. Michael starts making moves, careful ones, measured ones, not risky, just intentional. Daniel does the same, smaller scale, but same direction. And what happens next is where theory meets reality, because when real people apply these ideas, the results are not abstract, they're visible, measured, life-changing. Short sentence. And that's exactly what we'll walk through next. Part 3. From saving to designing money. Daniel doesn't suddenly become wealthy. That's not how this works. There's no magic jump, no overnight transformation, just small decisions made differently. He starts by asking a new question. Not how much can I save, but where should my money live? Short sentence. That's new. Before, all his money sat in one place. A savings account earning 2.5%. Safe, predictable, slow. With inflation at 3. He was quietly losing purchasing power every year. He didn't notice it, but it was happening. Now he shifts, not all at once, just part of it. $1,000 a month continues, but instead of sitting still, it starts moving into assets. Let's break that down. $1,000 a month at a 7% average return. After 10 years, he's not at a $120,000. He's that extra $53,000. That's money created by time, not effort. That's the first layer. Simple, accessible, but we're not stopping there. Because Michael goes further. He already has income. He already has assets. Now he starts working on structure. His advisor walks him through something practical, not theory, real steps. Step 1. Separate ownership. Instead of owning his rental property personally, he places it under a legal entity, an LLC. This doesn't eliminate taxes, but it changes how income flows and how risk is handled. Now, instead of rent going directly into his personal income, it flows through the entity first. That gives timing options, distribution options, flexibility. Flexibility is everything. Let's say that property generates $24,000 a year. Before, Michael would take that as income, pay taxes immediately. Now, he reinvests part of it inside the structure, new appliances, renovations, or even saving toward another property. That income hasn't disappeared. It's just being used differently. And this is where most people misunderstand. They think wealthy families hide money, but what they're really doing is controlling how money flows, like water. Same amount, different paths, different outcomes. Now meet Sarah. She's 41, works as a nurse, makes about $85,000 a year. She's done everything right, pays her bills, contributes to her retirement account, about 10% of her income, roughly $8,500 a year. Her 401k has about $120,000. That's solid, but something bothers her. Every paycheck, taxes hit hard, and she feels like she's stuck. So she sits down with a planner, and here's something surprising. Her 401k contributions are reducing her taxable income. If she contributes $8,500 and she's in the 22% tax bracket, she saves about $170 in taxes that year. That's real money. She knew saving was good, but she didn't realize she was already using part of the system, just not fully, because retirement accounts are one of the simplest ways to delay taxes, not avoid, delay. And that delay matters. If her $120,000 grows at 7%, in 20 years, it becomes about $465,000. If that money had been taxed first, the growth would be significantly smaller. Again, same pattern. Timing changes outcomes. So she adjusts, increases contributions slightly, not extreme, just intentional. She also adds another layer, a Roth IRA. This flips the timing. She pays tax now, but future growth can be withdrawn tax-free. Now she has two buckets, one taxed later, one taxed now. Options again. Meanwhile, Michael moves into the next level, family transfers. Instead of waiting decades, he starts moving assets early, carefully, using annual gift allowances. He transfers $68,000 a year to his kids. Over 15 years, that's over $1 million. Shifted, gradually, tax efficiently. That money doesn't just sit, it grows. In their names, in their future. Time multiplies everything. Fast forward 5 years. Daniel now has about $80,000 invested. Markets went up and down, but overall, he's ahead. If he had kept everything in savings, he'd have around $65,000. Now he's at $80,000 plus. Same income, different decision. And something else changed. His mindset. He no longer sees money as just spending versus saving. He sees layers. Income, assets, ownership, transfer. That's the upgrade. Sarah feels it too. Less stress. Not because she earns more, but because her money is working smarter. She's no longer reacting. She's planning. And this is the part people underestimate. Financial peace doesn't come from more income alone. It comes from understanding the system. 3 people: Michael, Sarah, Daniel. Different incomes, different starting points. Same shift. They stopped playing one-dimensional money and started playing the full game. That's rare. But even now, there's still one layer most people don't see. Not income, not assets, not even ownership. Something deeper. Something that explains why some families stay wealthy for generations, while others start over every time. And once you see this last piece, you stop thinking about money as something you earn and start seeing it as something you design. That's where everything changes. Part 4. Designing wealth across generations. There's a pattern you start to notice once you look closely enough. One family builds wealth, then loses it within a generation or two. Another family quietly grows richer over decades. Same country, same economy, different outcomes. And the difference isn't luck. It's not even income. It's design. Short sentence, long-term design. Back to Michael. At this point, he understands income. He understands assets. He's starting to understand ownership. But now, he's facing the final layer. Transfer. Not just giving money away, but designing how it moves across time, across generation. His advisor shows him something that changes everything. A trust. Now don't get lost in the word. Think of it simply. It's a container, a set of rules. A system that decides who gets money, when they get it, and how it's used. That's it. Michael places part of his assets into this structure. Not everything, just enough to start. A rental property, some investments. Now those assets don't technically belong to him personally. They belong to the structure. And that one shift changes how they are taxed, changes how they are transferred, changes everything downstream. At first it feels strange. Why would you give up ownership? But that's the wrong question. The real question is, what do you gain in return? Control, protection, and continuity. That's the trade. Let's imagine something uncomfortable. Michael passes away unexpectedly. No plan. His assets go through a legal process. Time-consuming, expensive, sometimes public. Fees eat into the estate. Taxes apply. Decisions get messy. This happens more often than people think. Now imagine the same situation, but everything is already structured. Assets move according to predefined rules. No chaos, no guessing, just execution. Quiet, efficient, intentional. And this is where the second shift happens. The deeper one. Wealthy families don't just build money, they build systems that outlive them. Let that sit for a moment, because this changes how you think about everything. If your financial plan only works while you're alive, it's incomplete.